When you're giving money to charity, is it better to do a donor advised fund or a qualified charitable distribution? In today's episode, we're going to have a battle of financial jargon and decide whether a DAF is better than a QCD. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Ramel, and I've got a fee-only financial planning in Chicago, Illinois. And before we move on with the battle of the acronyms, let's make sure you subscribe so that it helps us with YouTube and helps more people reach our channel. So, John, donor advised fund and qualified charitable distribution. Why don't you start? Yeah. Let's start with the donor advised fund and talking about just a few of the highlights of a donor advised fund.
Yeah. So we're talking about giving money to charity, especially as we're, around the end of the year, holidays and things as we're recording this. And a couple of great ways, a couple of better ways than just necessarily writing a check or sticking money in the bucket when you go to the grocery store sort of thing. And we work really hard on our show to try to avoid financial jargon, right? We got the jargon police, but there are some of these things, these titles, and I think it is useful to not have to say everything. So donor advised fund and DAF, right? So those are the initials that come in here. And a donor advised fund, we've had a couple of episodes recently on donor advised funds. We'll put links in the show notes to those. But a donor advised fund is, I call it a mini foundation. It's like a mini foundation that you can set up at Schwab or Fidelity or Vanguard or your local community foundation, where at very low cost and low overhead, you can put money into a fund and take a tax deduction for it when you put the money in, but then you can let that money grow and distribute it over time to various charities, right? At the end of the day, it's, if you want the details, again, go back here. We'll put those links to where we describe it in detail what those are. But one of the big advantages of the donor advised fund or the DAF is that I can take an investment that's gone way up. I bought, $10,000 worth of Apple stock and now it's worth $100,000. I could give all $100,000 of stock to the donor advised fund and pay zero taxes on any of those gains because it's going to charity. Like that's sort of the crux. Again, more details you can see in the previous episode, but that's sort of the crux of, hey, I can avoid taxes on this thing that's gone up. That can be a really great deal, right? But then there's another tool that we can use also, and maybe I'll turn it over to you, Bridget. Qualified Charitable Distribution, or QCD. Talk a little bit about the structure of that.
So a qualified charitable distribution, or QCD, is something that comes out of your IRA, all right? So you have to be 70 and a half for this to be in play, okay? So you have to be over the age. Donor advised fund, it doesn't matter what age you are. You can do a donor advised fund. But the qualified charitable distribution, you have to be over 70 and a half. So that's the biggest issue with it, actually. But what the mechanics of it are, you have an IRA, you get a checkbook from your IRA, and then you can write checks directly from the custodian to the charity. And then they can cash them, and that counts as part of your required minimum distribution, and it doesn't count as income to you. So they get the full amount, but you don't end up paying tax at your regular income tax rate on it. So this is a awesome thing. It's great.
And that's really the beauty of it.
$100,000 a year, but I don't see that as an obstacle for most people.
For most people, right? But I just wanted to pull out there that you're not taxed on it, right? So the money goes into my IRA through maybe my 401k or 403, right? I got all this pre-tax money that's never been taxed in my IRA. If I take it out, I got to pay taxes. Even if I then write a check to charity, right? Depends on my situation. Maybe I get a deduction, maybe I don't because of my itemized deductions. You get into some, arcane things in the tax law. But if I write a check right from my IRA and it goes to United Way or church or wherever, there's no tax. That money is 100% pre-tax, right? Avoid taxes on all that money. I mean, that's where some of the magic comes in with this QCD, in my mind, is complete tax avoidance. Of course, you're giving the money to charity, right? It's not like it's free lunch. But listen, if I'm going to give money to charity anyway, that QCD, the Qualified Charitable Distribution from the IRA, is something we need to think about. So, looking at those two options, right? It's great donor advised fund. I can give stock that's gone way up and I don't pay taxes on it when it goes to the charity. in the QCD or qualified charitable distribution, I can take money that's never been taxed and give it to charity tax free. And so what's your take on this, Bridget? Like, which one do I do? We get and we get this question periodically.
Yeah.
I'm interested in your take because I go, listen, we've got a client and they've got a lot of investments that have gone way up. I could use the donor advised fund. That could benefit. I'm also over 70 and a half. I could do this qualified charitable distribution. Which one's better?
Well, we're going to talk in a generality, and then we'll talk. To me, it's you have to look at your specific situation, because there can be factors that make it different in your specific situation. But I would say if you're under 70 and a half, it's donor advised fund. And if you're over 70 and a half, the QCD is generally at least as good of a deal or a better deal than the donor advised fund. And the reason for that is the donor advised fund saves you tax basically at the capital gains rate versus the QCD, which saves you tax at your regular income tax rates, which are generally higher. So that's my rule of thumb. Now, I have some clients that don't want to mess around with QCDs, and they itemize and they take money right out of their IRA, and Illinois doesn't tax that. And so, there can be exceptions to the rule, or they might not even have much money in a taxable account. So then for sure it's a QCD. So I think that age is the biggest tipping point.
Yeah.
Like,
No, I was
that's
just saying, I agree with you. And it's, for me, I'll put even a little finer point on it. If you're under 70 and a half, you can't do QCD, right?
Yeah.
So that is the only option. If you're over 70 and a half, and I appreciate there certainly can be some instances, it's hard for me to think of any of them. Being in Wisconsin, Illinois, right? There's no tax on IRA distributions. So that changes the metric perhaps a little bit for folks that are local to you. But in 98% of the time, I expect certainly that, hey, when that question comes up, that QCD, doing it from the IRA is in general what I expect to be a better deal. And you just described it very well. I appreciated that. Like, listen, when money comes out of your IRA, you're paying regular income tax rates, which are higher than the capital gains tax rates. I'll tell you the other thing that comes up for us with those sort of decisions, or like why I landed on the QCD and giving money from your IRA being a better deal, is for many of our clients, they're not going to use all of the money that they have, right? That this money is going to go to kids and grandkids in some fashion. And when you think about that, so as you just described, listen, if I'm going to use my money today, taking it out of the IRA is a higher tax rate. Let's give that one to charity. And if I need to sell some stock, even that Apple stock that's gone up, 1,000%, I'm only paying 15% probably in capital gains tax. But take that a step farther down the road and listen, money that's going to my kids, if I leave an IRA to my kids, they have to take that money out all within 10 years now and pay the regular income tax rates at their tax rate on it. If I leave them behind that, Apple stock that's gone way up, they get the so-called step up in basis, meaning I put in 10,000, now it's worth 100,000. When I kick the bucket, they get that money and they can sell it with no capital gains tax at all. Right. So on the stock side of things, going to the donor advised fund, hey, all things being equal, a donor advised fund, appreciated stock totally makes sense. When we're talking about, I can take something in an IRA that is going to be taxable to somebody and make that tax-free going to the charity. And I can take the stock that may be taxable if I sell it, but may be tax-free to my kids, right? Like, that's a really great deal, which again points me in that direction of, hey, taking that money from the IRA and going to charity and making that money that's taxable to somebody else all the time, making that tax-free going to the charities where there's real power.
Another point, I really like your points as well about inheriting, but there's another point I want to make too, and that is for people who are over 70 and a half and are, again, taking the required minimum distributions are more than they really than they spend. So they have to take out more than they want, and they give it away a decent amount to charity. That doesn't get included in your adjusted gross income, the QCD. So for Medicare Part B and D, that is based on your modified gross income. And so if you're concerned about that, I think right now the limit is if your income is under like around 200,000,
Something like that.
yeah, it's in that range. But if your incomes are over, over that, then you have to start paying for Medicare Part B and D. And so that's another thing that people are watchful about.
It made me think of two other things here, and then we'll wrap things up. But one is, and you just described, like, listen, I don't need my minimum distribution. I have to take money out of my IRA, but I don't need that money. Great, let's give it to charity. We've got other folks too, where they're spending all of their money from their RMD from their IRA, right? Now we didn't have to take out $30,000. We're actually taking out $40,000 to live off of. Even at that, for the reasons we described before, listen, even though it doesn't, it can kind of get convoluted with our RMDs, but the idea is like giving above that limit, I think still makes sense for those reasons we talked about. And then one last thing before we wrap up is when you do write those checks from your IRA and it goes to the charities, those checks have to be cashed before the end of the year. It's not like other charitable donations where if I write the check today, I get credit when I write it. It's when the charity cashes the check. So you just got to be aware of that at the end of the year here.
Right, exactly. So I encourage people to make the donations before December, actually, and be checking them. And sometimes people even call the charity and say, "Hey, cash the check."
Yeah.
So that's awesome, John. So with that, let's wrap it up. I'm Bridget Sullivan-Mermount. I've got a family financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. And both Bridget and I are taking on new clients, so we'd love to hear from you. But if you like what you hear and you look for an advisor in your preferred advisor in your local area, both Bridget and I are members of the Alliance of Comprehensive Planners, a group of fee-only, tax-focused financial advisors who think similarly to us. So if you want to find an advisor in your area, check out acplanners.org.
And please subscribe.